this is the problem people run into. They have a big nest egg of retirement funds. They think, I'm going to pull from that and that's going to be my paycheck, every month or whatever. As they pull from that and that balance starts to go down, all of a sudden you get a drop like this and you have that moment of panic where you think, what if it drops more? I don't want to keep pulling from this. And now that is your livelihood, but it has just dropped and you deal with all these emotions. That's why I think that's a terrible plan, is to base your future on this basket.
All right, Mike, we are back again with another episode of the Daily Dollar. Today is August 7th. People have been looking at their 401k balances over the last couple of days and panicking, probably dialing up their financial advisors, wondering, what do we need to do? What should I be looking out for? What is next? What do you got?
I think everything going on right now in the economy has kind of been pointing towards this direction. I think there was kind of a panic sell-off when the Fed came out and announced that they're going to hold steady, but most likely cut in September. Unemployment was up a little, inflation was down. So all of a sudden the market reacted very quickly. A little bit of stuff in Japan, but realistically, that doesn't have the greatest impact. If we look at things over the last 12 months, this has been pretty much a clear crystal ball of what was going on in the economy. And it was just a matter of, at some point, it was going to finally hit a wall. And a couple of days ago with the sell-off was kind of that first fracture and that wall that we finally hit.
For sure. We've had a couple of reports come out right there at the end of July, early August. We had the jobs report and obviously the Fed rate. Do you think investors are using those two reports that weren't necessarily favorable as kind of retaliation, right? A lot of investors pulled out. A lot of big companies saw some major losses in their worth. Do you think some of that's retaliation to some of those reports?
Here's realistically what happened is the economists on the inside, these people know, they've been watching and they see the economy slowing down. No matter what a report says, you can see it in the data. Unemployment keeps ticking up a little, inflation slowing down. You can just see in the earnings reports of these companies that earnings are down, which just signals that the economy is slowing down. Here's what happens, and what always happens, is the insiders try to push to that final moment. So stocks keep rising in spite of bad data. Earnings come out low, but stocks keep going up. That's counterintuitive. That shouldn't be happening. But what is happening is they're watching and saying the Feds are going to cut rates. That's going to spur growth. And these insiders are trying to squeeze every last penny before the drop. So when those reports came out, that was kind of that signal where everybody felt like we've hit the peak, bail now before this drops. Now, if you look at something like Warren Buffett, they just released that he went to $200 billion in cash. He sold off the month prior. Warren Buffett, being a value investor, he talks a lot about not trying to time and hit that perfect peak or that perfect valley. Just know that you're in the valley or know that you're just about at the peak. You don't have to hit that peak perfectly, but human emotion, everybody wants to hit the peak and sell at the top and then wait till the very bottom and buy at the very low. The reality is when you try to squeeze that, all of a sudden when that signal hits, everybody that was trying to get to that final peak moment sells off and bails for safety. And then you see that sell-off. There's a lot of automated trades out there. So when you have big sell-offs all of a sudden, that triggers automatic sells that these other people have in place. And then when those start triggering, that sell-off just keeps going. And then every fail-safe of an automatic sell starts triggering one after another. You get that. And then we have a big sell-off. And now you're starting to see people come back and say, all right, let's actually analyze where are we? And now you're starting to see the buy back up. And it's stabilizing. Interest rates on the bonds, the yields are starting to climb back up a little bit. The stock market is starting to climb back up a little bit. So that's realistically what happened is everybody tries to push that final moment. They get to the final moment, then everybody at once bails. All the automated trades start, and you feel like there's a huge sell-off. And then within a couple of days, everybody gets their feet under them and says, all right, what are we doing here?
Yeah. Realistically, the people that watch this show, a majority of them hold a lot of their investments in their 401k, right? These big moves, these big triggers are happening with those day-to-day investors, the big Wall Street companies that are, they have, to your point, right at those peaks or right at those valleys, they have trigger points where they're going to buy or sell. Everyone else that has money in their 401k really shouldn't be panicking, right? It's the old saying, I believe it was Warren Buffett, maybe it wasn't. Timing in the market always wins over timing of the market. So don't try and be one of those day traders. If all of your investments or a majority of your retirement accounts are 401ks and IRAs, don't try to time the market perfectly, but have your time in the market. What are your thoughts on that?
Yeah, I mean, you can see, so if you look at historical data, the reason for that is because you have that big sell-off, so then people freak out and they sell off. Well, they're selling at the bottom because when they recognize and it hits the news, that drop has already occurred. So you're selling now at the bottom. You missed that gap, at the top. So now you're selling at the bottom. Well, what's happened over the last few days now is that steady, slow climb back up. So now you're wondering, do I buy back in? So now you sold down here and now you're buying back in on the upswing. Well, there's going to be another event where it drops again, but people that get emotionally charged, they're always emotionally charged and they sell at the bottom. And then when it starts climbing back up, they think, oh man, I want to jump in and buy again. Well, now they're buying more towards a peak again. So they're always kind of missing that. And historically then, when you miss those rebound days because you pulled out of the market, that's when you start to see overall historical losses on your portfolio. So you sell at the bottom, you miss this 2% gain that we had over the last couple days. Well, now that 2% gain is gone forever. Now you jump back in, we drop a little bit again, you freak out, you sell. Now you compounded that 2% loss of a gain into a 4% loss, and over time it just keeps getting worse. So if you're going to be involved and you want to care about it, you really got to watch this thing all the time to know, all right, this is the direction we're going. I don't have a huge stock portfolio. We do mostly real estate, but I did pull all of my capital out of stocks and put it into cash a few months ago. I just saw the economy was slowing down. You knew this was going to come. You just didn't know when. And trust me, it was hard to swallow to pull my money out and see that stuff keep climbing, because I knew I pulled out before the peak, but I just didn't know. I thought the peak could happen at any moment. And it was a few months early, but then you see and you realize, okay, I just have to be willing to swallow 2 months of basically unrealized gains that I could have had to not be a part of this sell-off when it hits. Cause I was sitting in cash, and I'm still sitting in cash there, but that's the emotions. If you're going to be a DIYer, you have to be willing to back off before the peak, and you have to be willing to jump in before the bottom of the valley, just knowing that you got a lot of upside coming. And that's very hard, and it takes consistent knowledge, watching these reports, keeping up with everything going on in the market on a regular basis, at minimum monthly, weekly, or daily really is where you got to be, to keep your finger on the pulse of that.
Yeah. Do you see yourself soon getting back into the stock market, or are there other markets that you see as more favorable based on everything that's going on, what you forecast, over the next 6 months? Personally, where do you see your cash going?
I mean, for me, man, I really like the real estate game of being slow. We lock in a property with an interest rate for 5 years. It gives us a ton of leg room there. I like to have a little bit in stocks, but it's for that purpose, to have liquid assets to get out quickly when need be. I honestly don't like the emotional roller coaster of having to pay attention and having to watch where that goes. And I really don't have it in there to be a long-term investment. It's meant just to outpace, a savings rate and be a good liquid asset. So, I mean, signals would have to show that we're really at a bottom for me to jump back into the market, because I think rates are going to come down, but I think that's going to be a slow trend for the economy to rebalance. So I like real estate. I like private business. I like where I can put my cash and have a very good handle on it and be able to personally pull triggers within that business or real estate to make it do better, versus putting it in a stock market and just hoping things go well.
Absolutely. So you think about some of the signals that you were just mentioning. For the folks that have dollars in 401ks, IRAs, some of those retirement accounts that maybe they are 45 and they don't really care. They know that there's going to be more swings like this in the next 15 years of their career. What would you say to the folks that are maybe 60, 62, that have already rounded third base, of their career? They're heading towards home and they're seeing all of this happen. They're seeing their 401k accounts just drop drastically. What are some of the signals they should be looking for? Should they be pulling out cash or pulling it into cash, or should they just ride it out? Because there are signals out there that are going to get us right back to where we were.
Yeah, I mean, I can't really give advice because everybody's got a personal situation and everybody's going to have different...
It's the emotion that you were talking about, right?
Willingness, to do things. But that's why I just am not a fan of the retirement myth. That's why I say that it's a myth. I think you should buy back your time slowly, replacing it with good investments and passive income. We focus on real estate. You could obviously do something as simple as dividend stocks, but you're slowly replacing that income, because this is the problem people run into. They have a big nest egg of retirement funds. They think, I'm going to pull from that and that's going to be my paycheck, every month or whatever. As they pull from that and that balance starts to go down, all of a sudden you get a drop like this and you have that moment of panic where you think, what if it drops more? I don't want to keep pulling from this. And now that is your livelihood, but it has just dropped and you deal with all these emotions. That's why I think that's a terrible plan, is to base your future on this basket. I think it's much better to buy back time over your career. So by the time you're ready to retire, it doesn't really matter what the stocks are doing, because even if a stock drops 10% in value, if it's paying you a set dividend, I mean, 10% off of a little dividend is not a huge hit on your income like it is on your big basket. You know, if you have $1 million, you lose 10%, you see a $100,000 drop. That's like, oh my God, this is huge. What are we going to do? If you're getting a dividend of $1,000 a month and you have a 10% hit on that dividend, you lost $100. You know, $100 a month is not going to drastically change your emotions and your outlook like a $100,000 loss in your basket of money will. So I think it's important to always look at that. But yeah, I guess if you're at that point, you don't really have time to go back and buy the assets to kind of buy you out of work, and you have this big basket, I think you have to care about the market and read between the lines more than most do. I don't think you can just casually let it be. And if you are going to be a casual person, you cannot jump in and out on a regular basis, because you will always be a couple percentage points behind. And over time, that will compound into major losses compared to what just staying in the market would do. I am super excited to introduce to you the Doctors and Dollars 5-Day Financial Challenge. I'm Mike Neubauer, I'm CEO of Grand Vision Companies, and I'm the one that you see on the Wealth Wednesday and Daily Dollar episodes with Nate. So Nate and I are partnering again to do something even more exciting, which is the 5-Day Challenge. We're taking the best of all of our episodes, all of our expertise and knowledge, and we're condensing it into an impactful and purposeful 5-day presentation, 1 hour per day, for 5 days, to give you everything you need to build that foundation for your financial future. So if you're looking to gain the pieces, you want those puzzle pieces and find out how they fit in your financial plan, head over to the Doctors and Dollars website, join us on the 5-day challenge. We're putting it together for free, so you got nothing to lose. We look forward to seeing you on the inside.
Yeah, that's a good comparison. That was honestly going to be my thought. The last thing you said was like, now if you're in the situation that I described in my question, now is the time you need to get a little bit more curious, right? You need to learn a little bit more about what the market's doing. You need to be looking at it more on a daily basis or a weekly basis, not, hey, every, once a quarter I go and check my balance in my 401k, or I log in and look at the headlines and decide what my emotion for the day is going to be based on what those headlines say. You need to get more inquisitive. You need to get more curious if you're in that type of situation.
Yeah, the reason for being curious and paying attention is because, like we talked about, when this sell-off came, the Fed came out, announced their announcement, unemployment numbers, Japan, all this stuff. When this came, if you decide to jump in the market at that moment and start paying attention, it seems like, oh my God, the world is crashing around us. What is happening? But for us, if you watch for the year prior and you've seen all these indicators leading up, when that news hit, it just wasn't a surprise. There wasn't that big emotional response because we really were waiting for it to happen. Like I said, I switched to cash months ago. So for months, I was waiting for that day to happen. It could have been another few months. It could have happened sooner. But either way, it just wasn't a surprise. The data was showing this thing is slowing down and a soft landing is going to be hard. It's more likely a hard landing, and that announcement is coming at some point. And that's why, we didn't have that emotional response, because we're in it on a daily basis.
Yeah, we've been kind of bracing as far as like all indications show this is going to happen. So when the news came out, really it was Monday morning, right? August 5th. It was, today is the day. Like now we are here. And then it was just kind of fun. We didn't record a Daily Dollar on Monday, but just some of the headlines that were out there just causing panic. I can't imagine. I mean, I'm no longer a financial advisor, but I can just imagine, back when I had 300 clients, how many of them would have been calling me saying, what do I do? Help, like throw me a life raft. It's like, no, we're going to be all right. We're weathering the storm. You don't need the dollars tomorrow. It will correct. This was the, I don't know, would you call it like the tipping point? Like that the Fed saying, hey, we're not going to change rates. The job markets, talking about unemployment. Was Monday kind of the tipping point that we've kind of been waiting for? We've kind of been peeking over the edge. And now, last Monday was the jump.
Yeah, so we have all kinds of politics going on, with the election year, we have all this stuff. And realistically, I think any insider, if the outsiders like us realize the economy is slowing down, the insiders definitely know it, which simply means then that there's way more variables going into their decisions than they would ever let on to be. It's not just unemployment, inflation. There's way more going on. So I would say it is a tipping point, but really the purpose of that tipping point was just finally that the Fed and the news outlets, they can no longer paint a rosy picture, because they knew behind the scenes it wasn't as rosy as they were saying it was. So this was a tipping point where finally they said, all right, we can't bluff anymore. The economy is struggling a little. We're going to have to do something. And like I said, we saw that for a while. I think a lot of people did. that we listen to. So it was just a tipping point in the fact that the narrative is now changing. No longer does the narrative have to be the economy is doing well in spite of this, in spite of that, the economy is chugging along. Now that tipping point gets to change the narrative where now they can freely say there is some fractures in the economy, we're going to have to do something, and that narrative changes, going forward. So they needed a tipping point in order to change course on their story.
Yeah. Do you think now with current state, the economic instability that we have, do you think this forces the hand a little bit of the Fed to now come September, they've got to make a rate cut, whether it's their traditional 0.25% or do they need to go 0.5%?
Yeah. So, it's an impossible decision. So they have a million variables and they have to make the best decision for the United States as a whole and for the people that live here. So that should be their guiding force. They also have an election year. So no matter what they do, they're going to be wrong for one side. So if they cut rates, the Republicans are going to say, you cut rates just to boost the economy for the Democrats. You're bought by the Democrats. That's why you cut rates right before the election. That's unfair. If they don't cut rates and the economy keeps struggling, the Democrats are going to say, you did it for the Republicans. You were scared to make the right choice because you thought you'd have political backlash. You knew the right choice was to cut rates. You did it simply for political motives, and because of that, the economy is struggling, and the Republicans forced your hand to do that. So no matter what, the political realm and what's going to be thrown out there from both sides, they can't make a good choice because whatever choice they make, the opposite side is going to have something to say about it. I do think, personally, I think they will cut because I think the economy is too tight, and I think both sides realize that without a cut, we're going to have some major pressure. So I think they will cut, but I think there's going to be backlash and people mad on both sides no matter what.
Oh, I would agree with that 100%. What do you say to the folks who, like us, we watch and listen to a bunch of different economists just to, people who have been doing it a lot longer than us and helping us digest that information a little bit easier. And then we pass it along, obviously, through the Daily Dollar to others. A lot of people watch Warren Buffett. He made some big moves, within the last 30 days as far as sell-offs. As people look at that and say, well, he's one of the best investors that ever lived. He's making some big moves and selling. What are some of the triggers there that maybe Warren Buffett saw that caused him to sell? And how does that translate to the average everyday investor?
Yeah, Warren Buffett is just a very simple of like what we talked about is he doesn't try to hit every peak and valley. He just tries to play the trend. So Warren Buffett has a very simple approach. When I say simple, I don't mean easy, but it's a simple approach that you value the market, you value companies based on a total independent decision. You look and say, this is what I think this company should be trading at. If they're currently trading below what the value is, then it's a buy. If they're trading above what you think the value is, it's too high and you don't buy it. So he's just been watching this, and whether the market and all of these charts say the economy is going to keep going up or stocks are going to keep climbing, he already knows based on their independent research, this is what it should be at. So once it gets above that, he decides, all right, I'm going to start selling off. So his big sell-off was Apple. So that means he has an independent opinion of price for Apple stock. Apple stock was quite a bit above what he thought the value was. So he just simply said, I think this is overpriced. We're going to sell off and get into a big cash position, because if this is overpriced like these other companies are, when they get back down to normal price, there's going to be a fall, but there will probably come a day in the near future when these companies are underpriced, where the value of them is actually higher than what they're trading at. So we're going to get in a cash position and wait for that day to come. So really, it's a super simple way of investing. It's not looking at charts and making decisions based on that. It's simply, what is the real value? Is this trading above or below that? When it's trading well above it, you sell, and then you sit on cash until you find an investment that's trading well below the real value.
Yeah, 100%. I think not only Apple, him getting out of there, I think of people who were invested in like Nvidia, who saw a huge drop in value in the last 72 hours. I got to imagine that sell-off was a similar thing. Hey, we're selling because of what's going on around us. But now this is a great opportunity for people to jump back in when the price is down, when it is undervalued or underpriced. This is a great time for people to get in. Are you a big believer of individual stocks in this type of climate that we're in right now, where there is a lot of volatility, all the different variables that you've already talked about over the last 20 minutes? Is this a time to get into individual stocks, pick certain companies? Or are you still in the belief of, mutual funds and ETFs, keep it broad, spread your dollars out?
You got to be a professional investor to choose individual companies. I do not think 99% of people could analyze Nvidia or Apple and decide if it's underpriced or overpriced. I don't think they have the understandings of how many shares are out there, what the expected sales are, how to value iPhone versus a new Vision Pro that's coming out. I think to understand deep down what the actual value of one share of Apple stock is worth, I don't think a majority of people can sit down and look at a business and analyze it in that way to make that decision. Warren Buffett has a special gift that he built his company based on that individual skill, but now he has a whole team of people that are analyzing these individual companies on a regular basis to decide what is the true value. If you have that skill and you feel like you could sit down and look at a company and break down its balance sheet, break down its income statement, look at its management staff, and decide, I think this should be trading at $100 per share, and then you look at the price and find out it's trading at 80, and you're confident it should be at 100, then that's a 20% discount on the purchase price. That's a good deal. I just don't think that most people have the ability to nail that $100 mark to say, this is what this company is worth per share. I think the knowledge gap there and the understanding of how to analyze a company is just too large for most people to go and just pick an individual stock.
Absolutely. Last question I have for you. Kind of broad, maybe not. Just thinking about everything that's going on with the stock market that has overpowered the news in the last couple of days. How does the turmoil, I guess you could call it, is the best word I could find. How does this turmoil impact other markets? Oil and gas, real estate, international trading, things like that. How are those markets affected simply by, S&P and NASDAQ and the Dow being down?
I mean, every market's going to be independent. Oil and gas will have its own independent issues. I mean, most likely the wars in the Middle East that could be erupting will have more of an impact. But all this stuff is integrated. It's just not as easy as saying this is exactly how it affects this. We do mostly real estate, so I'll stick with real estate. I do think there's a lot of two things: pent-up demand for people to get into real estate. So we're talking housing market all the way up to commercial properties that people have been waiting for rates to drop so that deals will pencil out and they can move forward on them. I think there's a lot of breath of fresh air and relief for people who are getting close to their loans maturing in the commercial world, and they're saying we're going to be stuck at these high rates, we can't refinance with these high rates. So they're starting to see a glimmer of hope that rates will be coming down just in time. So I think it will definitely help the real estate market. The other thing that it does with real estate is when people are looking for safe assets and they feel the stock market is no longer safe, they jump into other asset classes, which will bode well for real estate and really all other asset classes. But when there's fear in the market, people look for a safe haven, and real estate, I believe, will be a nice spot for that safe haven. So you'll see a lot of liquid coming into the real estate market, which helps boost prices and raise the values of properties because cap rates start getting lower and lower, that people are willing to place their money for a smaller return just because it's safer than being in the market and potentially losing money. Absolutely.
Good insight. Final thoughts as we designed this episode to be around that panic of the 401k, right? I had family members, I had friends that texted me saying, hey, what's going on? My 401k just dropped $30,000. As you see the landscape that we're in last 2 days, maybe over the next 2 weeks, what are some of your final thoughts on the folks that are in their 401ks, in their IRAs? What should they be thinking? What should they be looking out for?
I mean, final thoughts is just that it feels good to have a narrative in your mind and believe this is correct, and then that is affirmed. So it feels good to have these beliefs and find out, okay, I was right, because you start to realize, okay, we have an understanding deep down of what is going on here. So I would say two things with that. If you care about this and you want to be a part of it, you really need to dive in and learn this, because it takes years of practice and finding out what worked, what didn't, and finding out, okay, I can read between the lines. I can start to see between the data and what the news is saying. So you need to build that skill. So if you care about it, you need to really focus and build that skill. If you don't care about it and you don't want to build that skill, then you need to really find a way to ignore the news headlines and stay out of it, because otherwise you'll always be trading and buying and investing on emotion, which is going to lead to not a good outcome. So I think that's kind of my final thoughts. And if you want to, something like we have the 5-day challenge that we do. So I think that's a good place to just build that foundation, and kind of get that base. So you start to find out, okay, how do I think differently? How do I interpret these headlines differently? How do I actually analyze and look at data so I can make a good, knowledgeable decision here? So I think that's probably what I would do, is start focusing on building that foundation and that knowledge base so that you can get ahead of the headlines and you're not surprised by the headlines, whether they're good or bad.
Absolutely. There must have been some telepathy there, because that was honestly my final thought too, is if you have interest, now's the time to go out and build that knowledge, build that base. You can do that with the 5-day challenge that Doctors and Dollars is putting on. If you're not interested, right? If you don't have time, if you don't have interest in doing something like that, then now is the time to align yourself with someone who does. Lean on them to give you that information. Someone that you trust, someone that does have their nose in the trenches, sees some of those, forecasted things that are coming up. Perfect example is the Daily Dollar. We obviously have the Wealth Wednesdays. We have our other podcasts where we are following this stuff. We've had these thoughts for the last few months. And to your point, it does kind of feel good that we were on the right track and this validates what we were thinking. So there's a lot of resources out there. The Daily Dollar is going to keep coming. Jump in, get into the 5-day challenge, build that knowledge if you want to. If not, keep watching us and we'll keep bringing the news.
See you tomorrow, man.
Talk to you later, buddy.